Welcome to the Stansberry Investor Hour. I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Dan is actually on stage. We're at our Las Vegas conference, so I'm riding solo here, but lucky me, we have a fantastic guest, Josh Brown. Just got done doing a presentation on stage and signing copies of his book. You weren't supposed to see that.
The mood is electric in this place. I don't know if you could feel from the moment I walked off stage.
Yeah, it was a great presentation.
Yeah, I feel like I really brought it and feeling good.
Yeah, cool.
So
we're happy for you to be here. You're, of course, CEO of Ritholtz Wealth Management.
Yes.
Which now has almost $7 billion of assets under management, you said, and you likely seen him on CNBC and the great Compound and Friends podcast and YouTube channel. And perhaps most importantly, you're a Long Islander like myself.
I am.
And we're very proud of it.
But I never left, unlike you.
Well,
I'm sticking it out.
It was a little too expensive for me at the time.
I'm going to ride it out.
And that's how I ended up here,
All right.
learning about money and whatnot, and listening to cool people like you.
All right.
We could go a lot of directions here. But maybe, and we'll get into what you talked about in your presentation a little bit, but I just want to start by reading something back to you that you wrote in a blog post last year, so that I think will kind of set the stage for our listeners and viewers pretty well.
I will not confirm or deny that I actually said this.
If that's okay.
Okay, until I hear it.
June 2024 on your website.
Okay.
I'm a former stockbroker with no formal education in economics or econometrics, which the latter word, I couldn't tell you what it means with a dictionary in my hand.
That's true.
Which incidentally is very funny because our director of research, Matt Weinshank, great guy, has a master's degree in econometrics.
Well, holy shit. That's the man I need to talk to.
He's around. You can talk to him next. You went on, I don't know anything. I started in this business cold calling Dun and Bradstreet index cards with the names and phone numbers of business owners. I'm an alumni of the speculative fever swamps of stockbroker land in Syosset, Long Island. No pedigree, classically trained with a plastic black telephone, a headset, and an Acer monitor running Quotron.
Yeah.
But like most of you, I have my own 2 eyes and 2 ears and try to understand what's going on. These have been valuable if we've learned how to use them. I think that says a lot about what you do, I think.
Yeah. I get to meet a lot of really brilliant people and a lot of people that do have a substantial, impressive pedigree, where they went to school, what degrees they have, PhDs, where they worked, what their first job was, who their mentors were. I get to meet like very impressive people. I think what I bring to the table as not being one of those people, I think I am both the go-between between those people and the audience, and I'm also like in the audience too. Yeah. So that's the way I see myself and my place in the financial media, and I'm very comfortable with that. I think I'm smart. It's not that I think I'm like an idiot, but I don't put on airs, and I don't come from a place of I know everything, therefore listen to me. I have opinions. I fight for them, change them. I think that comes through. I think that's what my audience appreciates about what I do. And it's still sort of unique. I think most people in the financial media, they only want you to know how smart they are and how great they are. And I guess I've never really come from that place, and hopefully people appreciate that.
That's kind of what I was going to ask you was, like, why do you think it's so hard for so many other people to learn to like trust their eyes and ears?
Oh, that's easy. Oh, wait, I thought you were going to ask me a different question. I jumped the gun. Why is it so hard for people to not act that way?
No, why is it so hard for people to trust their own eyes and ears in investing in general?
Oh, well, a lot of people shouldn't, because if you don't have a lot of experience and you haven't been around that long, you should be in search of other people's opinions.
Okay.
I don't trust my own eyes and ears when something's wrong and I go to a doctor. I kind of want to defer to the doctor. So I do think that there is a place for putting trust in professionals and listening to people who know what they're talking about. But I also think people should have some confidence once they've been in the investing business or the investing game for long enough. They should sort of be able to rely a little bit on their own instincts. And it's a process like everything else.
What question did you think I was going to ask you? And what?
I have no idea. Okay. No, but you know what? So not to brag, I interviewed the greatest investor of all time, 10 days ago.
Peter Lynch.
Peter Lynch.
I watched it.
Okay, so I asked him,
Yeah.
I said, so he wrote the definitive book for individual investors. One of maybe the best-selling investment book of all time. One Up on Wall Street. Still a classic. And I asked him after all these years later, he wrote it, I don't know, 40 years ago-ish,
Yeah.
late 80s. What is that, 36 years ago?
Yeah.
So I asked him, like, do you still think after all these years, now we have institutional investors who are armed to the teeth with data, and Bloombergs, and charts, and statistics, and high-frequency trading tools, like, do you still think that the regular investor can do it themselves and can be one up on Wall Street? And he said, yes.
Yeah.
And he's, the names change, the stocks change, the market's sped up. There's a lot of things that are different, but like, if you have common sense and you're willing to do research, you can still do this. So I think that's a good message, and I appreciated hearing Peter say that after all these years.
Yeah. What was that like sitting there interviewing him? I mean,
Nuts.
He was like one
the
of your
craziest
idols,
thing
right?
So you have to understand, like, when I started in the business, I was 19 years old. It was in between my freshman and sophomore year of college. I was a cold caller one summer. And the first book they gave me,
Yeah.
this is 1996. I was 19. They say, read this.
Yeah. Wow.
I had no idea I read it.
Yeah.
I had no idea what any of the words in the book meant. I listened to
This
them.
is very familiar to me, by the way. Yeah.
But I read it and I revisited it, once I knew what the hell I was doing. But like that's like foundational for me. So to get to sit next to him and interview him for a live audience, it's like the most insane thing. It's probably one of the top highlights of my career.
Wow.
So,
yeah.
I mean, this is great too. I don't want to give you the impression that this is not.
This is
no, this is cool.
Me and Peter Lynch.
This is cool.
Okay. All right. Okay. Well, just so you know, this is up there for me.
All right.
as well.
I appreciate it
because you've established yourself clearly as probably one of the most prominent market commentators out there, right? I mean, people know you from
for better or for worse.
For better or for worse. People know you from CNBC.
Prominent is a good way of putting it. Yes, people do have to hear.
Well, I'm
me.
a writer by nature, so these are, I'm better with words than talking.
I don't know if this comes. I hope this comes across. I love the stock market.
Yes.
I fell in love with it at that age, and
why'd you fall in love with it?
I watched the senior brokers. I was not licensed, so I could not pitch stocks.
Okay.
I was a cold caller, just
Yeah.
connecting people.
Yeah.
It's like, hey, you want to hear a stock idea? Hang on, like that. But I got to watch these guys do what they did, and of course, it's like silly now. Like nobody does this anymore. But for a very long time, that's how people bought stocks. They were pitched an idea, and so in that summer, I watched Callaway Golf, Snapple Iced Tea, Boston Chicken, like they all came public. And I watched these guys pitching these stocks and telling the story of why people should buy them. Yeah. Boston Chicken didn't work out so well. I don't know if you heard. But like
Snapple's good though.
I was captivated by the idea that anyone could learn the story of a company, put money, invest directly into it, and have that grow and become more money. Like, I don't gamble. We're in Vegas.
Yeah.
I didn't even look at a table or I don't have that gene. I don't have the gambling gene.
Right.
It's not exciting for me. I don't get much out of it when I win. So like I don't even bother. But I have the investing gene and I get really turned on by that idea of like, wait a minute. These are publicly traded companies. Anybody can buy in. All you have to do is learn the story and be right eventually. And like you can make more money. That is the coolest thing on earth. And I still feel that way all these years later.
Yeah. No, it
28 years, 29 years, I still feel that way.
Yeah, no, it definitely comes through, right? So, did you have any influences, mentors, like from your like before you got into the business, like who were interested in businesses and stocks, like from your family or anybody? Like, how'd you get into that?
So the last chapter of my book actually tells the whole story, but I'll give you the abbreviated version. I had anti-mentors.
Yeah.
I had people that I was only able to learn what not to do from.
Yeah. Which is valuable.
I mean, it doesn't feel that way in the moment.
Right.
I worked for pirates, gangsters.
Yeah.
These were guys that were running some of the most notorious boiler room brokerages in the history of, I wouldn't even call it Wall Street, because all of this was Long Island, Brooklyn, Staten Island, New Jersey, Boca. I mean, these firms, these were firms that, you know, it was before it was called FINRA, it was called the NASD. The NASD had all of these firms on a list of companies we need to close down. That's where I learned the business, not on purpose. I didn't know any better.
Right.
All the guys were wearing suits. Yeah. They all drove Porsches. I just assumed these are successful people. But they were anti-mentors. And I guess that's not the worst thing. But I watched what they did with their clients, to their clients, and all the lessons were, all right, never do that. Yeah. And I accumulated a lot of that. And that, I guess, is what enabled me to figure out, okay, so if I don't want to be that, what do I want to be? So that's the sort of mentor. For better or for worse, it all worked out okay. I'm not complaining. But I never had a role model in the early days of like, this is who I want to grow up to be in this business.
This might be a tough question to answer, but do you feel financial media how close is it to the ideal of what you would want it to be in general?
I mean, I don't care. I don't get upset. Like, there are people that are like vocally displeased with financial TV, financial articles. They yell and scream at the Wall Street Journal or Bloomberg or CNBC. I don't give a shit, honestly. I'm trying to build a business, and I'm trying to help my clients. I don't have any other causes. I'm not looking for revolutions. It doesn't faze me, to be honest. I show up. I do financial media. I'm a guest. I'm a host. I'm a contributor. I am what I am. And my job, I feel, is to communicate with the audience that cares about my opinion. And I do the best I can.
Can we talk about maybe a little bit about what we're seeing right now in the market? A little bit maybe about what you talked about on stage. We're in this bull market that just keeps on going.
I think it's a bull market.
AI trends. I
think it's a bull market with some bubbles within the bull market. And some of them are small enough that there's no need for concern. And some of them are maybe in the foothills of becoming really big bubbles. And I wouldn't say we're like in a full-fledged mania. I don't think this market is as reminiscent of 2021 as a lot of people do. I don't think it's 1999, and I was there. So, this is not something I read about in a history book. I lived it. I really don't think it's that carried away. Just think it's a regular bull market, and yeah, there are some people acting extremely speculatively, and what would you expect? They've made a lot of money doing so.
Mm-hmm. One of the things you talked about was just how underestimated the earnings, the power of American company, the potential of American companies to just keep increasing their earnings over the last.
I think it's the whole thing.
40 years. Yeah.
The two things that actually matter for stock prices are earnings and interest rates. I mean, there's other factors. There's regulation. There's economics. There's demographics. There's geopolitics. Of course, like there are a lot of things, but like when you boil down what fueled bull and bear markets historically, were earnings growing or not, and was the cost of money rising or falling? So here's what we have right now: sustained earnings growth and falling interest rates. Like I don't really think it's more complicated than that.
Everybody wants to know if
you talk to everybody?
Everybody.
Okay.
A lot of people want to know about is this AI going to end up? Is the AI trend going to turn into a bubble? Is the boom going to turn into a bubble?
Yeah,
it is.
It's going.
Okay. You think we're in like 90?
Oh man, I wish I could be the person that could tell you that definitively.
But you do think it'll end up?
Yeah, it always does. Yeah. Though it's not a profound statement. Like people are like, no, this ain't going to end well. It never ends well. There's one of my favorite lines from the movies, Cocktail. How old are you?
39.
Remember Cocktail? No. All right. Tom Cruise at his apex, peak Tom Cruise. It's got to be 89. of
Okay.
90.
Okay. Yeah. No, that was young. So
Anyway, Elizabeth Shue is his girlfriend, and they're dating, and then they start fighting, and she said her family doesn't approve of him because he's just a bartender, and she's like a rich girl, and they have this fight, and she says, something to the effect of like, I don't want this to end badly, and he says everything ends badly, otherwise it wouldn't end. It sounds so simple, but it's so profound.
yeah.
Of course, this ends badly. The only question is when and to what extent, like how bad. But it's okay.
Yeah.
Like other bull markets have ended badly too, and here we are. So I'm not good at that game. Like what inning we in?
Yeah. Okay. Fair enough. So how do you translate kind of the way you think about the market and about all these things we're talking about into advising clients? That's a whole nother thing. Like you can have your view, but then your relationship with clients, like managing, a lot of times what you would want to do might not match up with their goals, right? Or their personalities or whatever.
Yeah, so I'm of the belief that my client base, they're going to live way longer than they think, and they're going to live way longer than the actuarial tables tell you, because we work primarily with high net worth. And so it's one thing to know that the average life expectancy in the United States for men is 74 and for women is 78 or whatever it is. Amongst the top 10% of wealthy households, it's definitely not that. It's way longer. So people that think they're going to retire at 65 and be dead at 75, it's really not going to go that way. The reality is they could have decades of life long after they're earning income, which means they're going to need a lot more money later in life than they think they will, which necessitates risk-taking today. You can't not have risk. The only decision that you can make is when do you want it. So we prefer to have people take their risk now while they're still earning money and while they're able to. And that means equity-heavy portfolios and the emotional necessity of living through drawdowns and accepting that that's part of the deal. You can't have the upside if you're not willing to endure the temporary downside. And the reason that becomes so important is you may have a portfolio, you may have a lifespan that requires a portfolio to grow for a way longer period of time than prior generations. So our investing philosophy is to just be very aware of that as we build financial plans and then build portfolios that will satisfy those parameters. And, the other alternative is, okay, you don't want to take a lot of risk today. Well, your portfolio will not grow as much as it could have, and then you have risk on the back end of your life. Right. You didn't make enough money with your investments, and now what are you going to do? Now you're out of the most precious resource, which is time. You need time to be able to compound. So if you are not compounding now, you ain't going to be able to do it later. So I think we're very frank about the expectations people need to have about taking risk. And I think overall we've done a pretty good job given the growth of the firm and its organic growth. We've given people that message. The market has done very well, so have they, and it's been right.
How has your firm changed from the earliest kind of days to now where you got billions under management?
We were cavemen. We started the firm in 2013. There were 4 of us and an assistant.
Right.
The assistant was right out of college, her first job. One day, she said, I'm going to go take a soul cycle class, and never came back. It's like, there's 4 of us, and we all wore 10 different hats. My partner Barry was was handling payroll. I mean, it's hilarious, but
yeah.
he was like on the phone with health insurance providers. All right,
HR. All right.
I was licking FedEx envelopes. You start a firm.
Yeah.
It's a guerrilla campaign. It's just like.
Who was your first client? You remember?
We started the firm with $65 million in assets.
65. Okay.
We lost our biggest client the week before we launched. It's a true story.
Yeah.
Our biggest client was $10 million.
Wow.
So we thought we were launching with $75 million. And he called us up. He says, I know you guys are about to leave and start your new firm, and I feel really bad telling you this, but I just bought a vacation home on the Jersey Shore, and I need to borrow money to close the transaction. I'm not, I can't get out of my company stock to do this, so I kind of have to do a securities loan. And I'm like, well, I don't know what that is. He's like, yeah, no, I know. You guys can't do that, but Goldman's going to do it for me. So he's like, I love you guys. You've done a great job, but I literally have to borrow $5 million against my portfolio right now. Yeah. So that was scary. So we launched the firm minus our biggest client, and the universe kind of conspired to make it work. Like, we put it on our blogs. Right. I still have the link to the blog post I wrote. Barry wrote a blog post like, hey, we are now Ritholtz Wealth Management. We launched our own firm. And people just came pouring in. It was the coolest thing ever. Like, not only did people call us to open an account, they were sending gifts. Like, somebody sent a case of beer and opened an account. It was a really special thing. And we realized very quickly, like, holy shit, we actually don't know what we're doing in a lot of areas. Right. The good news is, not only did clients come pouring in, but potential hires. So we just got inundated by people that wanted to work with us. And that enabled us to actually build something that has obviously, grown. But we needed a lot of help. We didn't even know what we needed until we found it.
Right. And I guess that there was so much interest right off the bat.
Well, so that's the part we did know what we were doing.
Yeah,
We're very good communicators, and we had built up this really great track record saying smart things and sticking to our guns and not panicking people for clicks. And when others were writing these hyperbolic headlines about double dip recession and it's 1937 and all this shit, like, we would debunk that stuff, and people over time really grew to appreciate our message. Yeah. And so we had that trust with the audience. So that part wasn't terribly surprising. I just didn't imagine the extent. I didn't know that we were going to be able to. We've grown at a CAGR of like 37% organically over the last 12 years. We're still at that same growth rate, and I never could have imagined it. So fingers crossed, things have gone pretty good, and we hope it'll continue.
What are your goals now for the firm, and overall? You just keep attracting more clients?
So what's changed now is we have a lot of employees who are counting on us for this place to last forever. Right. We have a lot of young, hungry, hardworking, dedicated people who love the firm. They fight for the culture. They really care about what happens. And I have to figure out, as the CEO, and I've never owned a business before, so I'm learning on the job, but I have to figure out, how do I scale and continue to grow so that we can do more things for clients, and we can provide backups and backups to the backups for our employees so people can be on vacation and the wheels don't fall off. Like, how do I scale but not lose the thing that made us special in the first place? Like, how do you add, so we're 80 people. Yeah. How do I go to 100 people without the firm feeling like it's a totally different place? Right. And people, start saying things like, oh man, this has changed. This used to be great. I don't know what happened. Like, that's the thing that I view as my primary responsibility, is to scale responsibly. And I'll let you know how it goes.
Yeah, we'll watch how it goes for sure.
No, people are like, well, what do you think? Not what keeps you up at night, but like, what's on your mind? What do you think about? Yeah. Like, that's what I spend a lot of time thinking about, and not just for the employee's sake, for the client's sake. Like, I don't want the clients.
That kind of your DNA goes through the whole thing.
We think of ourselves like Peter Luger, best steakhouse in the world.
Yeah.
That's what we think of ourselves. That's our opinion of our own service. Mm-hmm. I don't want my clients to start feeling like it's McDonald's. Right. And we're serving 85 billion hamburgers, and nobody really cares very much about, what's coming out of the kitchen. Mm-hmm. So I use a lot of restaurant analogies because I'm a big restaurant
You like food,
connoisseur. No, but that's how can the firm 2 and 3X from here, but still feel the way it's always felt.
You talked about on stage that you have, 4 meetings with families before you even put the money to work. Is that essentially
Yeah.
right?
So
Like
this is one of our natural advantages over other RIAs, and we don't really see other firms as competitors. I know they are, but we're very collaborative within the industry. We throw an event called Future Proof every year.
yeah.
We had it last month in Huntington Beach, California. 5,000 financial advisors came from all over the country, all over the world. So they wouldn't come to our event if they thought we were like ruthlessly competing against them.
Right.
But what was the question? Oh,
About the family.
our natural advantage is that when we talk to a family who wants to become a client,
Yeah.
if what they're looking for out of a financial advisory firm is reasonable, we're like very certain we're going to win the business. It doesn't matter who else they're talking to, because we've built up a trust with those people way before they ever reached out to us.
Yeah.
We didn't like randomly find them. We weren't assigned them at a Schwab or a Fidelity branch, like a referral. Like these are people that listen to us religiously.
They found you at some point.
Yeah, they believe in what we're saying. So it's like, we're going to win that business. So as a result, we're able to do 3 and 4 meetings before we get paid $1.
Yeah.
We're able to do all this upfront legwork. We can commit to doing that because there's a very high likelihood that person is going to become a client. Most firms can't afford to do that level of work prior to onboarding a family. So that's one of our natural advantages of having built a fan base that becomes a client base.
Cool. All right. You mentioned the Peter Lynch interview before. It's the highlight of your career, not this. That's okay.
No, you're like, this is like top 50.
Hey, okay. You like, and the lessons that you learned from Peter Lynch. Like, are there any, like, maybe 1 or 2 or 3 things lessons that you've taken from interviews that you've done or whatnot from the last 10 or 20 years that you've kind of like directly applied to how you manage the firm or how you manage money?
So I think I've learned large things and small things from people, even if what we do looks nothing like what they do. Yeah. So one of the first really established, super successful people on Wall Street that actually took an interest in me is Jim Chanos. Chanos is like obviously brilliant and one of the most successful people on Wall Street. Nothing that we do is apples to apples with what he's a short biased hedge fund manager.
Right.
Looks nothing like us.
Yeah.
But like I learned things from listening to people like that. And you don't always realize what you're absorbing. So like it's not always like some direct piece of advice like never do this on Tuesdays. All right, I won't do that on Tuesday. Sometimes you're just watching the way people carry themselves or how they think about the market or how you watch people, how they're building their enterprise. So like I've met amazing business people who don't even work on Wall Street. And I've picked up things about how they've built what they've built. Like my idols are people like Danny Meyer, Union Square Hospitality Group, founder of obviously Shake Shack, but like some of the best restaurants in Manhattan. He's got a book called Setting the Table, and it's just about hospitality. And his philosophy is people say they put their customers first. He actually puts his employees first. Because if you put your employees first, they're going to put your customers first. Like that, like those types of things. Like I absorb stuff like that. That's maybe not directly related to money management or investing, but it's like, oh yeah, that makes perfect sense to me as an entrepreneur.
Yeah.
So there's a lot of stuff like that, and I'm still learning every day.
Why did you write the book, your latest book?
The short answer is the publisher told me I should.
Okay.
You don't write books for money.
Yeah, you do not. Yeah.
I made a little bit of money, but it's like if you were to take the amount of hours and divide that by how much money you made, it's like less than a minimum wage job. So that's not really the thing. The thing with the last book is I wanted to put a capper on an era of time in my life and in the markets and just like put a punctuation mark after it. So this is a collection of everything that I wrote from the start of my blog, my first blog in 2008, to the end in 23. and I put an end to the blog in 23. And this was like all of the best lessons and ideas and takeaways and insights from that period. So I think it's a really great way to learn all the things, or for people to get this like panoramic view of everything that went on in the markets and in the economy. And then also there's a lot of personal stuff in there. And I thought it was just like a nice way to send off that era and begin a new chapter. So that's the real answer.
Cool. All right, go back to the market for a little bit. You've seen a lot of market cycles. Is there anything different? And you talked about it a little bit. Anything different about this market now, or is it the same stuff, just dressed up in a different way?
No, it's really different. The market has blown through so many things that used to be norms that just don't apply anymore. Yeah. There's an open question about whether or not the type of economy that we're in could ever even have a cyclical recession again.
Yeah.
I think we'll have recessions. They'll be driven by exogenous events. But in the 70s and the 80s, if you raised interest rates, you would basically halt bank lending. Right. And that halted bank lending would freeze financing throughout the economy. And then you would have companies dumping inventory, and then you would have layoffs, and it would be like this very predictable thing. Yeah. We just had the most aggressive rate hike cycle, one of the most aggressive rate hike cycles outside of the early 80s in history. And the market, the economy didn't budge. Nothing happened. It's like this extraordinary thing. So like just recognizing that it is different this time. It's always different. It's this idea that like every environment you're in has to somehow rhyme with a previous environment from the past is just not how it works in real life. So there are so many things. We used to take it as gospel that a yield curve inversion was an automatic recession. Yeah. You're on the clock.
Yeah.
We had
still
one like
waiting.
3 years ago.
Right. Yeah.
Where is it?
Yeah.
Like there's so many things like that.
Yeah.
So I think that's the big takeaway is how much things can change and permanently change.
And I guess that speaks to your idea of just the importance of staying humble and not trying to be right.
There's this really great story where from the turn of the century, 1900 to 1957, you could set your watch by this. Anytime the dividend, the treasury yield and the stock market dividend yield reached parity, right, you understand? Yeah. Like it used to be that stocks yielded more than bonds. That was the norm. Okay, whenever stocks went up so much that their yield dipped below the treasury bond yield, that was a sell signal for the stock market. And it worked all the time, instance after instance, every decade. When the stock market rallied, the dividend yield fell, and if it fell below the rate of the treasury, I think it was a 10-year, if it fell below the rate of the 10-year, that meant stocks were too expensive and you should sell them. And it worked, it worked, it worked. And you could calibrate, you could set your watch by it. And then in 1957, for some reason, and no one knows what it is, dividend yield on the stock market went below the yield on the 10-year. And not only was that not a sell signal, the bull market ran into like 1972. In 1957, not only was that a terrible time to sell, it actually never went back the other way again. The 10-year treasury yield has been above the stock market dividend literally ever since. Yeah. So now in 1957, you're this fucking know-it-all waving this sheaf of papers around. Look at the dividend yield. It's a sell. Right. You don't know that the world has permanently changed. How can you know? No one knows. You look like you're the smartest man in the room waving this stat around. Guys, this is the sell signal. It always works. Right. And then 75, here we are, 70, almost 80 years later, and things were never that way ever again. Right. So I collect these stories, and I share them with clients and other investing professionals because they have to know that things do change, and sometimes they change permanently. And you don't know if you're in one of those times. Right. You won't know until later.
Yeah. Why do you think the Why do you think we might not see these cyclical recessions again? I've heard a Fed official, I forgot who it was, say.
Rick Rieder is saying that. So he's probably in the running to be the next Fed chair. So smarter people than me are of this opinion. I think because we have gone from a manufacturing economy to a service economy, and the service economy that's very heavily equity financed, meaning the stock market is a bigger driver than lending rates for a lot of that service economy. Right. We have a lot of stock-based compensation in that service economy. I just think it reacts to different things than overnight lending rates. I mean, we just went through a very obvious period of that. So I think for that reason, if you don't have that same debt dynamic hanging over a manufacturing sector that dominates the economy, now it's a knowledge-based economy. I think that makes it a little bit harder to just have these cyclical run-of-the-mill recessions. I mean, I'm sure it could happen. I wouldn't say it can't. Yeah. I just think it's less likely than a lot of people that focus on the past think it is. So what will bring about the next recession? Probably something insane that none of us can think of right now.
Yeah, that's...
Sorry, but that's just the reality.
It is, yeah. No, it is. Does anything concern you, anything really worry you about this market right now?
I mean, there's always things to be worried about no matter what the market environment is. So I do think there's a ton of speculative activity. I think, unfortunately, a lot of that is concentrated amongst young people. I think a lot of young people don't really care for the investing process. I think they prefer the gambling. Maybe they'll grow up. But for right now, I think there's a lot of people taking a lot of risk that they don't understand. Some of it is paying off, and they're learning all the wrong lessons. You don't learn anything from your success. You learn from failure. There hasn't been a ton of failure. There will be. And so a lot of lessons will get learned. Maybe that's the silver lining, but that's one of the things I worry about.
Okay. You worry about stock?
Can't do anything about it, but...
You worry about stock valuations?
No.
No. All right. Fair enough.
Well, I mean, they could come down.
Right.
I worry about stock prices.
Prices, yeah.
Yeah. Not so much valuations, prices.
Okay.
I like them where they are.
Cool. So do a lot of people. All right, I think we're wrapping up here, but we'll get to our last question that we do for every guest. Same for every guest.
What is the fastest land mammal?
That's you.
Cheetah.
Okay.
Did I win? All right, God.
That is not the question.
What's the final question?
Simple.
All
if
right.
you need to leave our listeners or viewers with one thought, what would it be?
Oh, man. I don't know if this is off message for Stansberry, but this is my honest opinion. People probably spend too much time focused on what the market's going to do, what stocks to buy. I think people are spending too little time away from the computer, away from the phone these days. I think people sort of take their time for granted. And I end up, in my profession, talking to a lot of people toward, the end of their lives. Not like the day before, but,
Yeah.
Like none of them are like, I wish I had spent more time researching stocks. I wish I had spent more time reading economic reports. I wish I had spent more time listening to company conference calls. None of them. Like they don't. I think the number one thing is what people never regret are the experiences that they've had, even the ones that weren't great in the moment. And so what we try to instill in our clientele, and they don't need us to tell them this, but sometimes people need to hear things from someone else to validate it, right? We have people that spent 50 years of their lives saving. Everyone said save. They listened. And now, at 65, at 70, now we're telling them flip the switch, spend. It's hard. They don't want to hear it. But we have to explain to people. We have people, millions of dollars. One day I'm going to get that car. When? You think this shit's going to be more fun when you're 80? Do it now. Yeah. A lot of the job of financial planner these days, look, people's portfolios.
Like a psychologist too, yeah.
People's portfolios have way outperformed what the financial planning software said would happen.
Yeah.
We're doing 15% a year in the S&P over 15 years.
Right.
People have way overshot their goals. So now it's like more important than ever. It's like, you got to live. Spend the money. Buy the vacation home with enough bedrooms for your children and grandchildren. Do the thing. Do it right now. Like, that's a lot of what my planners do these days, and it's fascinating.
Yeah.
It's people would say, oh, it's a good problem to have. You don't spend enough money. Yeah, fine, but it's still a problem. So if I could leave people with anything, it's don't wait. Don't wait. Do the thing. You'll one day you'll be glad you did it. You won't regret that you did it.
Yeah. No, I think that message will resonate with our audience, and thank you so much for your time, man.
My pleasure.
This is awesome.
Thanks for having me.
All right, and that's another episode of the Stansberry Investor Hour here in Las Vegas. We hope you enjoyed that conversation with Josh Brown, as I truly did, and Dan will be back with us next week.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.